a lot of people who get into real estate, especially young guys who get started, they're all about leveraging it up, max leverage, 100%, grab whatever they can get. And they forget that part of running a business is about risk mitigation, right? And especially in the long run, for myself personally, my goal is to drop the amount of leverage I have on my properties down closer to somewhere around 50 to 60%. I know it's on the low side for a lot of people, but for myself, that's how I know that I'll never end up bankrupt.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How we doing, bud?
We're good. We are hanging in there, getting ready to see how the rest of this year shapes up, right? We are, when this airs, we may be close to already having a president or not. So we will see.
What is it? It is October 20th. So when is it? The 5th? Third. Yeah, so that's true. We might. I don't know. We're only a couple weeks delayed, so we may or may not. That'll be interesting to see. I'm curious, though. Do you think the election is going to have a large impact on anything in the real estate space or no?
I think it will, in the regards that if one president gets elected, if the Democratic Party wins, there's going to be there's a Democratic control in all three areas. So I think more things will get passed. Mm-hmm. So I think that will impact, where it's been a stalemate for so long. I think that would be impactful. Do I think impactful? Real estate values are coming down 80%. Do I think interest rates are going up 5 points? No. I just think that more things will change. What happens to tax cuts and opportunity zones? I think those things may get tweaked, but that's a very small piece of the space. So I think there'll be changes. I think it's going to be earth-shattering changes. I know there's someone on Instagram that you follow, Personal Finance Club. He had a couple of charts recently that showed Democratic and Republican GDP growth and budget deficits. And if you look at it, very little impact, right? It's more timing more than president, because you would be shocked at who's actually the top guy and who's actually the bottom guy, because it doesn't go with what maybe most people think. So I think there'll be a change. I think that, good, bad, or indifferent, I don't think it's going to change our lives dramatically. I think the world's in a fucked up place regardless of whoever gets elected. I think they got an uphill battle to go. So I don't know why anyone would want to be in that role, right? Mm-hmm. It's just it's a lose-lose. But we shall see. We definitely shall see.
Yeah. No, I think it'll be interesting. I have less experience going through a presidential election while being in this world, so I'm not going to give too much of an opinion because I haven't really gone through it. The only thing I do know is we were talking with, Rappaport does all the 1031 stuff, right?
Yep.
When we had him on, I remember he mentioned that the 1031 had been several times up for being cut or changed over the years. And I know that's part of Joe Biden's new tax plan is basically eliminating that. So it was interesting for me to hear that this isn't the first time it's come up, that it's been tried to get axed or eliminated before, and it hasn't happened so far. So I know a lot of people are anxious to see what happens there. So not saying it's not going to happen if he gets elected, but it was just an interesting note from somebody who works on it every single day that it hasn't happened so far. So we'll see what happens there. I'm not claiming to be an expert by any means, but yeah, I think for the most part, things change, but like any big changes, even for us in multifamily, things take time. So it's not like the election is going to happen and, the sky is going to fall out. So yeah, I tend to agree, but it'll be interesting to see how everybody kind of reacts, and it's going to make Thanksgiving and the holidays a lot more interesting. So I'm anticipating some fights. I know.
Let's go back to quarantine so no one can see anybody.
Exactly. Sorry, Mom and Dad, can't make it this year. But awesome. Let's jump in today because we got a really interesting guest on who is not from the States. So, has probably a little bit of a different take on what's going on, but I think does some investing here as well. So maybe we'll have a different perspective on some of that stuff and maybe we'll get into it. But with that being said, Steven, thanks for joining us, bud.
Hey, Chris. Hey, John. Thanks for having me.
Yeah, you got it.
Thank
So
you.
kind of teased it a little bit, but you want to tell everybody a little bit about you, your background, your journey, and what you do?
Yeah, totally, man. So quick bio about myself. I'm 25 years old. I'm currently in my last year in dental school. So I'm graduating this upcoming year in 2021. I got started in real estate investing when I was 17 by buying foreclosures in Phoenix and Atlanta. I was working with my brother at the time. And over time, we built up a pretty reasonable portfolio down there. And then I stopped buying for a couple of years. I came back to Canada and started investing in Atlantic Canada, where I got more into the small to medium-sized multifamily properties. And as of today, I've got 38 doors across 7 properties with another 18 units under contract. And this is mainly kind of working with my own cash and also working with close family and friends who are working as private lenders or as JV partners.
Awesome. So just so I know, are you like Canada native? Like, did you grow up there? Like, or was it, you were from somewhere else, spent a little bit of time in Canada, came down to the States? Like, I'm just trying to understand the relation between preemptive Canada and the US investing type of thing.
Sure. So myself and my family, I was from Taiwan originally. That's where I was born. I moved to Vancouver when I was 4 years old.
Okay.
And I've been here the whole time. I've never left. I've just been doing long distance investing. So I would make a couple trips back in 2013, 2014, a couple trips a year down to the markets that we're in. But there was a lot of properties that we were buying kind of sight unseen. We'd send someone in our team down there to take a look, get inspections done, and we would buy it without ever seeing it.
Right. So basically, raised in Canada. So why was it that you started looking in the US versus looking closer to home?
Sure. Well, the city I live in, Vancouver, it's one of the most expensive cities in the world, right? A single family home starts over $1 million today. You can't buy anything for under $1 million unless you're looking for a condo. And so for us, the investment thesis just didn't make sense because we were looking more for passive income and cash flow. And here, the only way to make money is appreciation, really. So that's what we started looking. And back then, we got involved with one of those like real estate guru coaching groups. And the premise was that they were teaching Canadians how to buy in the US and how to buy foreclosures because everything was starting to just come back out of the great financial crisis. So that's how we got started. And we decided to look in Phoenix at first. And then we bought one duplex there. And then because our coach, she invested in Atlanta herself. So we sort of piggybacked off her team and we bought quite a few more there.
Gotcha. Is there any reason, because I feel I get a very similar story for a lot of people who are in Canada of looking in the United States, and I've spoken to other people who live in Vancouver as well. Is there not a lot of markets locally that you feel do provide that cash flow in Canada? Like, do you just feel Canada in general is very saturated in real estate, not just in the immediate Vancouver market? Or was it, it sounds like you've bought some stuff in Canada since then. Do you feel like taking that experience from somebody doing it in the States and then now you've been able to apply it to other markets in Canada?
I think so. In Canada, we just don't have as many major metro markets, really. There's only a handful. There's the big ones: Vancouver, Toronto, maybe Calgary, Montreal, Ottawa, some of those bigger cities. Whereas in the US, you have a lot of those smaller cities that are still over 100, 200, 300,000 people. But they're still going for those really low price points, maybe 40 a door, 50,000 a door back then. Whereas here even in those smaller markets, you're easily looking at properties that are over $100,000 a door, right? So those markets where you have a decent population base, right, and good appreciation potential, plus a low price point and a good price to rent ratio, it's just much fewer. So the opportunities here are much more limited. So that's why initially we jumped over to the US. Also back then when we started, the currency exchange was much more favorable. right? This was close to when the Canadian dollar and the US dollar was 1 for 1. So now it's actually gone up to 1 to 1.3. So it's kind of cool because then we just made basically close to 30-40% on our money just from appreciation, right?
I was going to ask, I know now the Canadian dollar is, or the United States dollar is worth more, right? So that is probably great investing here because your dollar, now what's the taxes look like? Because I know we bought a property from a group it was it was from Argentina. How does that work? Like, do you guys 1031? Do you guys just buy and hold? Like, when do you decide to sell with the tax implications and the currency exchange and all that stuff? How does that factor into any type of underwriting or thought process on sale or refi and all that good stuff?
Totally. So we are mainly buy and hold investors. So we've been holding on to everything. We've only sold, I think, 1 or 2 small properties. And then for those, there wasn't really much of a gain on them. So that wasn't a concern. But in general, I was considering myself in the last 12 months to actually exit the US because my brother and I, we bought a portfolio of about 15 different properties now. I only hold 2 of them myself, a small fourplex and a single family. So for me, I had quite a lot of, legal costs and accounting fees because I just set up this whole partnership structure and like corporate structure. And, each year I was paying easily close to $2,500 to $3,000 a year in fees. And just for 2 properties, it was starting to not make sense, especially because all the properties I have, they've run up easily doubled in value. And like you said, there's that gain in currency exchange. So I was really thinking about selling, but then I decided in the end just to refinance it because for me, my philosophy is just to create that passive income. So for me, I'd rather hold something for 20 to 30 years.
So this is actually a really interesting question I want to ask and I want really for both of you, and I'll chime in as well. I was talking with someone about the prospect of like buying slow, refinancing, and just continuing to build up cash flow streams over time versus getting in, finding a deal, either forcing appreciation or getting appreciation, and then selling and continuing to scale up into bigger projects. Basically, if you buy it and you make 5% and then eventually you can get it upwards of 9%, but you've 50% increased your equity, 100% increase your equity or more, 9% on double your equity isn't anything great. Can you go repurpose that income? Why did you decide to then refinance and pull out money instead of cashing in on all that appreciation and going and replacing it into something else that might make you more? Or did you do the math and the refinance made you more? Like, how did you approach that situation?
So for my situation, yeah, that's a really good question. And, obviously it depends on everyone's situation. So myself, I'm not a full-time investor, right? If I was, I probably would have gone for the exit, cash out and then move all that locked in equity into more buildings since I am trying to scale up into more smaller to medium-sized multifamily properties. But because, like I said, I'm only doing this kind of part-time. I spend maybe say 20 hours a week just in the mornings and the weekends doing the real estate stuff. It's just much easier for me just to hold on to what I have, especially because they've been performing. Because what I find is for the first even 2 years when I buy a property, there's a lot of stabilizing and there's a lot of greater, higher expenses that I incur. And it's really only on the back end that I actually really see that cash flow, and it's actually really being passive. And those initial capital expenses that you may have not done or may have not incurred when you first did your initial renovation, all those, you're past that now. So for me, I wanted to milk the cow a little bit, get a bit more cash out of it instead of cashing out.
Yeah, that was one of the things that I brought up of, when you buy a property, there's so much that you don't know. Even when you do inspections, there's only so much that you can learn. And John, I was bringing up the difference between deals we bought when Lisa managed it beforehand versus deals when we didn't. And you look at the difference between River City Landing, the other 2, Park at San Marco versus the other 2. And you just have so many more surprises. And for me, it was always, if you can get into a property and fix those problems, like you were just saying, Steven, in the first year or 2, Well, now you've got something that is just way more predictable, and you know what's going on, and you know who the tenants are, you know how to approach them. You're putting your own people in. If there were problem tenants, you probably got them out, and you have what you are hopeful is good tenants. If there was problems with plumbing or big issues that kind of surprised you, you've probably taken care of them by now. And for the most part, you have a pretty decent understanding of what to expect. For me, it was, all right, if I can refi at that time, increase my cash flow, pull out some money, I've now got something that from a risk reward standpoint might make a lot more sense than pulling out all the money to go buy something new. And I'm incurring more risk potentially because now I've got a new unknown property that I have not been managing or owning for 2 years or a year or 3 years, that things might pop up, whether it's termites or plumbing or ACs or settling or foundation. I mean, the list goes on and on. That was the argument we were going back and forth. But to his point, he also said, like, how bad is that stuff? Like, those are all things you can probably overcome on a new property. It's just going to take a little bit more work and energy. So I'm right now more of the mindset, and I mentioned to you, Steven, pre-call that I'm in the process of buying a 16 unit. I'm more of the mindset of I'm trying to go in there, renovate, and pull out cash and hold it, because I feel the amount of work and headaches I'm going to have on that property is going to be so low once I get in, renovate, and do what I need to do, that it's going to allow me to then spend so little time on it. I can go do other things and spend other time on finding new properties, finding, other sources of capital, spending more time on just other things at the office, just frees up a lot of that stuff. Whereas if I put it into a new property, I'm going to have to go through that whole process again. Or if it's a bigger property, it's going to be double the time.
So
yeah, go ahead, John.
I was going to say and I'll say it, right? No one talks about it. The disconnect between sponsor and investor is real, right? A sponsor makes money by achieving certain hurdles and exiting properties and getting cash flow splits and IRR hurdles. And inevitably, real estate, the name of the game is not get rich quick. It's get rich slow, right? We have a personal portfolio deal that I own with 2 people. I have brokers call me every day because, we could sell it. And I say, well, I'm damned if I do, I'm damned if I don't. If, I can sell it and make a boatload of money, but where am I going to put that money that I'm not going to incur a risk of stabilization, right? I've renovated this property. I've fixed this property. I've put all the tenants in there. So we know that property in and out like the back of our hands. It cash flows really well. And yeah, there might be a ton of equity that we're not tapping into, but if I sell that, I have a brutal tax consequence if I don't 1031, and simultaneously now I have to go buy a property, and I'm going to have a 12-month to 24-month period where I'm going to learn it again. So I think that from an investor standpoint, buy and hold is the name of the game, right? I mean, you buy it, you let it do its thing, you fix it, you fix the problems, you put the tenants in it, and you cash flow. Then you refinance, recapitalize it, and pull out your money and go do it again. And when you get that consistency of cash flow coming in, especially if you're doing it part-time, that's super important. Whereas on the other side of the coin, if it's a rougher neighborhood or there's something about it that you don't want to be in that area for a long time, I would lean to the, let's do what we got to do and be out of this thing, right? But at the same time, what I tell all our investors, listen, our visions are aligned. I want to execute this plan. But where our visions differ is that you want to hold it for cash flow and I want to sell it for a profit. And that's the hardest thing to overcome. But one thing that I've been trying to do with our investors is educating them. And when I send them out investor docs and they look at them and they say, wait a second, why'd the splits change and there's no pref anymore? I've been educating them on, guys, we're going to own this for 10 years. If I have a ridiculous hurdle in there and I'm not going to make money, and this goes for every sponsor, whether they want to admit it or not, if it's not going to, do what they want, if it's not going to work, they're going to forget about it and they're going to go buy another one because they're going to try and make that one work. And this one's going to fall off the wayside and it's going to hurt everything. So we're raising money for a mobile home park that is actually basically funded. And I had one investor I sent docs to, and he said he committed $100,000. He was ready to roll. He's an investor that's invested in a ton of our project. He's a really good investor. He saw the documents and he was like, no shot, man. I'm not signing those. There's no pref. I said, fine, you're out, because I wasn't negotiating. It is what it is. But it goes to that point. I personally agree with both you guys. There is something to be said about buying a property. Listen, a 250 unit sexy multifamily deal with a major value component is awesome. But there's something to be said about a 100 unit, a 90 unit, a 16 unit, a duplex, a quad, that you can go in, do what you got to do, take that 12 months, 16 months, 24 months, get it where it has to go, and either refinance and hold or just hold. And your risk reward, you might not be making a 30 IRR because you didn't sell it, but if you can get a solid cash flow out of that thing and you can go to bed at night and you know what you have, I think the risk reward is just significantly more, knowing that the risk is less, right? You've taken the risk off the table, and in anything you do, de-risking is ultra important. So I'm on that page as well. I side with the long-term. If you already own it, you know what to expect. As if you buy something new, things are going to come up that you weren't expecting.
Yeah, totally, John. I think something I want to add on there that you mentioned is, a lot of people who get into real estate, especially young guys who get started, they're all about leveraging it up, max leverage, 100%, grab whatever they can get. And they forget that part of running a business is about risk mitigation, right? And especially in the long run, for myself personally, my goal is to drop the amount of leverage I have on my properties down closer to somewhere around 50 to 60%. I know it's on the low side for a lot of people, but for myself, that's how I know that I'll never end up bankrupt, right? Because I've spent too long. Well, I say that I'm still pretty young, but I spent a bit of time, right, working on building up my portfolio. And in the future, when I'm working, say, building my dental practice, right, that's going to be a lot of blood, sweat, and tears put into it. And my goal isn't to be the absolute richest I can be. It's to create a stable platform where I can take my life, take my family's life, and do what I want with it, right? So part of that is going to be risk mitigation. Right now, myself, I am very levered up because I'm working with a lot of private lending, a lot of joint ventures, right? There's a lot of debt under my name, but I know for myself in the future, part of the game plan is about 10 years out, I'm going to start dropping that leverage down to a point where I can easily sleep at night and not worry about if the market decides to tank tomorrow, I'll still be fine.
So I love that people don't talk about it, because the whole everything out there now, all these coaches and gurus, it's all about, except for the few that, no debt. I'm not saying that no debt is good. I'm not saying that debt is bad, but like the deal we're doing right now, no debt. It's 100% in cash and it's risk adjusted for that purpose. So people see, they're like, okay, that's a good IRR. I'm like, well, no, if I throw 50% leverage on this, the IRR is going to go through the roof. And I'm a huge believer in that, right? There's something to be said about, the biggest risk that anyone has, this happened in 2007, 2009, there were banks that were calling performing loans. That happened where they said, I don't care if it's performing, we're going out of business or we're losing our shirt. We want that lender back. We want that money back. And as the borrower, we've had multiple podcasts where I've shit on banks, and I truly believe that they dictate everything. I'm a huge believer in, the lower debt, or, like I pay my mortgage for my house. I do an extra payment a month, and I've had people say, why are you doing that? Like, what are you going to do when you pay it off? I was like, I just want to go to bed at night, right? Like, I just want to know that, it doesn't matter to me, right? Even if I have all the equity in my house or part, it's irrelevant to me, because I know if I go to bed at night, if I take the risk off the table of debt and my debt service is less, or, if you take that major expense off your bottom line, right? Your cash flow is better. You are more predictable. If something happens and you have to do a roof, you're not doing a capital call or infusing money. Maybe you have some extra cash flow that you can use, or a larger reserve. So I think there's something to be said about that, that people don't talk about. And there's nothing wrong with 50, 60% debt. I mean, you can get really rich doing that, and you can go to bed at night knowing that my deals are performing. And if something goes sideways, I don't, like, just look what happened in Corona, right? Where there was so many missed payments and forbearances. And something I read the other day, the census predicts 1 in 3 Americans can be under eviction and or foreclosure when this is available, whether it's January 1st or they propose it. So you're talking about 1 in 3 people in this country could be under eviction or foreclosure. That's crazy to me. So, how do you take that risk off the table? Lower leverage or something like that. So I said there's definitely something to say about that. And you have to understand that if you're looking at a deal and you don't have that leverage upside, understand that your risk is less. So your return should warrant that, and you can go to bed at night. So I'm glad you said it, because people don't talk about enough. Right now, it's all about, I'm going to take this credit card and max this one out and buy that house and take 90% debt, and I'm going to get a private lender. And yes, that happens, right? But realistically, if you could take that risk off the table, there's something to be said about that. And I like that.
Yeah, I think it just comes back to the problem for me is people don't understand the risk and reward and how it relates. They just hear, I can buy a property with no money down and I can make money, and they're like, oh, this is great. Like the whole Airbnb arbitrage that we spoke about, John, it was nobody had a really good understanding of what it meant. They just thought, oh, I can make a ton of money by not owning any real estate. I can take a 12-month lease for $1,000, Airbnb it for $100 a night, and I'm going to cash flow, $1,500 a month. Totally fine. But you got to understand that you have a revenue stream and you own nothing, and that if it goes away, you're shit out of luck, and possibly you're going to owe somebody $1,000 a month. Good shot. You could go find somebody to sublet it and take on that lease, and you'd be out of whatever it costs you to furnish the place and do some other stuff. But it's the same concept of so many people we talk to don't take the time to properly evaluate the capital stack. And John, we spoke about this on another episode with preferred equity now becoming more and more popular in syndication. It makes the returns hit 15% for a normal investor, but they don't take into account that there's now somebody in the mortgage as the first position, the preferred equity as the second position, and you're still getting the same returns you've been expecting, but there's now somebody in line in front of you that if things don't go 100% according to plan, you've got to wait for them to get your money. It's not all the equity is now treated the same, and nobody is really understanding that relationship. And I would be shocked if it's being explained in a way that makes complete sense. But it's also on a lot of passive investors too. I just don't think there's enough accountability where so many people are just investing in these things without properly understanding. I was just going back and forth with someone on Instagram. He's like, hey, I saw Grant Cardone's fund doesn't have a preferred return. I worked for, I forget the company, but we always had a 9% preferred, and then here's the splits. And I said, one, I don't know if that's what Cardone's doing. I can't say, but I said, two, if it's happening, it's, people either don't know what the market is, they don't know what they like, or they're comfortable with it, or they just don't look and they don't care. They don't take the time to properly evaluate it. And it's so true. I mean, the amount of investors that we have that get the investment summary and don't even ask the question or don't even look for it is astronomical. I mean, John, for the mobile home park stuff, I got to imagine I could probably guess who it is. Honestly, I won't say it, but I could probably guess who it was. But I guarantee almost everybody else didn't even look for that or ask that question.
It was relatively shocking. Most people just signed them, right? A handful of people read them, and everyone that read it said, well, this isn't like your normal deals. I said, well, this isn't our normal deal. That's why it does. It's not. And yes, there was a handful of people, 2 or 3, not that many. And then mostly everybody else was asking totally different questions, completely disregarded the structure. No one really looked at that stuff. And listen, I wasn't trying to hide it, right? It's out there. It's in a document. You get a, private placement. It's in there. You get an operating agreement. It's in there. It is everywhere. It's right in front of you. But people, for whatever reason, the words and the documents, they look at the pretty pictures and the returns. And I get it, right? I understand that, right? Everyone does it, right? Christmas, right? Everyone wants to open presents Christmas Eve or before that. No one really wants to wait. But at the same time, you got to make sure, one, that you have confidence in whoever's running the deal, that the operator knows what he's doing, because that's inevitably how the deal is going to work or not work. And then two, you gotta understand it, because that little pref piece or whatever that is, it is a position that's treated differently, and that's on that specific situation. But inevitably, you have to understand that, and understanding the risk is half the battle, and nobody's educating people on the risk, right? nobody's educating people on the downside. The only education out there is how to go buy a deal at this cap rate. There's a deal being marketed right now, and they are literally selling the deal at a 5.07 cap on a deal that it's got no shot at working. And if it works, listen, I'm the first one here. I'm not going to name the deal. I'm not going to name the 18 sponsors involved, but I'm telling you right now, the deal is not going to work. It's just never. It's not a 5 cap market. It never was, and it is today because debt is cheap. And I've had people reach out to me saying, "Well, the deal works because of the debt." And I know in the episode with Jonathan Twombly, I said, your deal can't work because your debt makes it work. Your deal has to work because it's a good deal, and then the debt should only amplify it and say, or make it better, right? That should be gasoline to a fire, not the match that starts the fire, because you don't know what's going to happen in the debt world. Interest rates could go up, down, left, right, or sideways, and you have no clue what's going to happen. So buy a deal because it's a good deal, and then have the debt fit the deal as opposed to the other way around.
The funny thing, John, is that if you mentioned that you had a 5 cap deal here in Canada, people would be jumping all over that.
No, I know we've had a couple Canadian investors, and I have a friend that 2 friends live in Toronto, and they actually bought a property in Cleveland. And when they were buying it, they sent it to me, and I was like, guys, that's aggressive, right? They're like, well, no, you're getting a 2 cap in Toronto. I'm like, I understand that, but you don't want a 5 cap in Cleveland. You just don't. So no, but you're 100% right. I mean, listen, there are countries that have negative interest rates right now. And there are countries where real estate is extremely difficult. Canada happens to be one of them, where you're buying. I mean, I've gone skiing in British Columbia. We've skied, Whistler and all that.
Oh, yeah.
You drive through Vancouver, you fly into Vancouver, you drive up or whatever. And it's a crazy market. I mean, there's massive buildings going up left and right. And that's just a norm. So you're 100% right. People hear those numbers and they get excited because it's like, wow, 5 cap is phenomenal for us. Now, it works as long as it's a buy and hold. But if you're going to try and buy, renovate, and flip it, and you're buying a low cap rate in a market that may not warrant it, that's when you're going to run into some issues. At the end of the day, if you're going to buy and hold, you could buy 2 caps or 3 caps or 5. It doesn't matter as long as you're playing the long game with good debt, so on and so forth. So I get it 100%.
Yeah. I think people need to remember cap rate is not a reflection of debt. It's a reflection of risk reward. And it goes back to your point earlier, Steven. You said there's not a lot of markets to invest in Canada. So because there's not a lot of these areas available, not a lot of markets, naturally, there's going to be a compression on the returns people are willing to take. But in the United States, it's significantly larger. There's significantly more markets, both large and small, where you can go out and do it. So the problem becomes, if you're going to buy a 5 cap in Cleveland, but you can buy a 3 cap in downtown Manhattan, yeah, you're probably going to need more money to do that just because the buildings are bigger in Manhattan. But is the risk reward for a deal in Cleveland versus Manhattan worth 2%? Or is it 3%? Like, that's what you have to weigh up. I don't care if your debt is 0%. That's not what it's a reflection of. Yeah, it's a nice bonus, and that's what John was saying, and that's what we talked about in our episode with Twombly. But it's a risk reward, and you're comparing against other investment opportunities. You also got to be weighing it up against, if I can go buy a treasury bond, what am I going to go make? Because that is almost as guaranteed as you can get. Real estate is not guaranteed.
Yeah.
A treasury bond from, the United States, I don't know what it's like in Canada, but if you can make 1% guaranteed every year, how do you compare that to a 5 cap or a 4 cap? Like, those are the things you have to do. It's not a reflection of debt. It's a reflection of the investment opportunity versus other opportunities. And there's a lot of things that get weighed up in the real estate deal that you're looking at. Not only location, age, tenant base, the location, the opportunity, all that stuff comes into it.
Yeah. And you know what, Chris? Those are some of the high-level things that people here don't talk about enough. Mm-hmm. And the thing about a lot of Canadian markets is you have a large majority of rookie investors or mom-and-pop shops trying to jump in. And like you said, we'll have people here who will look at an Airbnb deal or a student rental deal and say, oh, this 6 cap rate or 7% cap rate is the same as a strictly multifamily long-term rental deal, right? And they'll view it as the same thing. And that's where we have these prices just being driven up because people are thinking that a short-term rental hotel business is the same as a long-term multifamily business, and they're pricing it the same way, right? And I think that's part of what contributes to just the prices shooting through the roof in these Canadian markets, right? We also have much cheaper debt. Like I think people are getting close to just under 2% long-term debt here too, right? It's insane.
That's crazy.
Yeah.
No, it makes sense. I mean, that's a huge thing. I mean, we said it before COVID happened with the Airbnb stuff. It's significantly more risky. It's way more volatile. It's why hotels tend to trade at higher cap rates than, before COVID, and it impacted the whole travel business. Even still, hotels traded at higher cap rates because they're just, they're less stable. You don't have somebody in there for 12 months. You have somebody in there for a day or a couple days. Like, that adds risk to it. Your pricing goes up and down more frequently depending upon seasonality and, occupancy and other things that are going on in the market. When you have a 12-month lease, it doesn't change for 12 months unless they don't pay. Then they leave, you kick them out. So there's that extra element in there. So, I agree 100%. I've seen some deals that are trading at, crazy low cap rates, but they're Airbnb models, or they're selling it, telling you can turn it into an Airbnb model, which I think is hysterical. It's just, it doesn't add up. Not all things are created equal when you weigh these things back and forth. So it's super important from that regard. And it's why, you go the other end of the spectrum, you look at something like a triple net lease, in these awesome areas, people will take, very low cap rates because there's significantly less risk in these things where basically all the expenses are paid by the tenant. They're in there for, 5, 10, 15, 20 years, depending upon what it is. And, all the tenants have certain credit ratings. So if you get like a, top of the line credit rating in an awesome location, you're not going to make a heck of a lot. But if you buy a shitty little retail strip in a lower end market in Long Island and everybody's on 12-month leases, well, you're going to get more for that because there's more risk involved. So, it's the same thing of weighing it back and forth.
So one thing that we just did, I was working with someone yesterday on it. We looked at, for longer term holds, doing 13 and 15 month leases. And it's actually interesting when you actually break it down, when you do a regular turn cost of $650 and you do the vacancy factor for 14 days. And when you factor that in, when you go 13 and 15 month leases, you actually, on a 100 unit property, you'll make an extra, and netting it all out, you actually make an extra almost $13,000 using an average rent of about $750. So at a 10 cap, you actually increase the value by $120,000. And that is pretty cool because everything's 12-month leases. But when you factor that in, if you actually sign some longer term leases, if it's a longer term hold strategy, your two biggest expenses on any property is vacancy and turn cost, because it costs money. Oh, yeah. Your vacancy is massive, and your turn costs, you need people to do it. So there's labor, materials, and whatever damage they did. So if you get good paying tenants, and I'm actually going to talk to our managers about this because I think it's an interesting thing, because I know sometimes people say, "Oh, don't do a long-term lease. You're gonna miss out on rent growth." Well, we factored that model in on the two numbers I actually mentioned. You actually pick up about $38,000 in cash flow by just getting rid of your vacancy and your turn. Now, when you factor in your rent growth, and I factored in a 5% rent growth, which is probably high for right now. When you factor that out and net it out, you actually still pick up $12,000. So it's something that I've never spoke about. I've never spoke about it everywhere, but I was talking to a buddy of mine yesterday, and he's an engineer, and he was putting the whole spreadsheet together. And I was like, now I got to go bring this up to managers, because it's a totally unique perspective that most people in our position aren't doing. Now, maybe a single investor does it, but a long-term tenant is great. Yes, you're not going to get the rent increase, but that rent increase is nominal compared to your turn and vacancy factor. And if your vacancy is 1 month, it's probably even significantly higher. So it's a really cool thing that I'm going to see how we can roll it out. We're not going to do it across the board, but every once in a while you get a lot long-term tenant locked in. They're also long-term tenants are probably more likely to treat the place better. So when they leave, it's probably not as messed up, because they're probably people that like the security of knowing their rent's not going up or they're fair. Also, the other thing it will do is it'll probably leave more meat on the bones for the next person because they'll see a lower base rent when they think they can raise rent. So, but it's a cool concept that we're rolling out. I don't know if you've ever thought about it or if you even do, longer term or shorter term leases, but I think it's something that is really unique. And when you start putting it on paper, it becomes a real concept.
You know what, John, you can't see me, but I'm writing down notes. I've never heard of that. And I think that's a fantastic idea. No, that's totally true. And that's something I experienced too. Like when
Sorry, go ahead. Keep going. Sorry.
I was just saying, like when I first got my first property, we had 3 to 4 months vacancy, right? And that expense was, like you said, it was just through the roof. So for you, even if you're seeing savings, even on a 14-day vacancy, that sounds like a good model.
Yeah, and I'll actually at the end, I'll send you the spreadsheet you put together. It's really simple to just plug and play your turn cost, your rent, your lease loss, and I'll send it to you at the end of this. And anyone listening, if you want it, reach out to us, and I have no problem with sharing it because it's nobody talks about it. I know even on our calls, our management calls, we talk about short-term leases to get them to expire at the right leasing season because you want to get the pop on rent. But I bet if you wait it out with a major increase or versus your vacancy, I still think that the longer term lease probably yields a better cash flow. Now, that being said, if the guy's paying $600 and the market rent's $1,000, well, then obviously the model's not going to work. But if the market rent's $700 and the guy's paying $680, and you put him in a longer term lease at $680 or $700, it will work. So you got to keep that in mind, right? Obviously, the spreadsheet, you can make it not work, but it was thrown together quickly, and it's something I am actively going to start talking to our managers about because I'm sure there are people that do it, but it could be huge, I think.
So when I was looking at apartments in the city, a couple agents that people did was what they would do is they would offer you a 12-month lease first, and then on renewal they would offer you like 18, 24-month leases. So that way it's like, okay, if you do 1 year and you don't completely screw up, I don't have to evict you, whatever, then we'll quote unquote, reward you with the longer term lease where you're not getting, renewal pops every 12 months. And maybe that's a way to kind of like bridge the gap too, because especially depending upon where you are, big thing, if it's going to take you 6 months to evict someone, you may not want to do an 18, 24 month lease or 15 month. You may want to stick with the 12 just in case.
Correct.
But this could be a good way to bridge of like, hey, let's give them a 12-month trial, right? If they don't have any problems, good chance that I'm going to have a better outcome with a longer term lease. Not saying that people don't, be great tenants for 36 months and then in the 37th month, they just start not paying for whatever reason. That does happen. But it could be a good way of like, hey, we're going to get you in 12 months. And if things go well, we're okay with offering you a longer term lease. That may be a good way to bridge the gap. So you're like, okay, this is a quality tenant. I don't have to worry about evicting someone with a longer term lease and seeing how that goes. You do have to be careful though, because I'm just thinking, John, remember Lisa said for a 15-month lease or longer in Florida, you need a broker to sign off on it in person. So, just anybody in Florida, apparently that's a thing. I don't know if it's a Duval County thing or a Florida thing, but also make sure before you go do it that you can do it and there's not anything holding you back. So,
and I think the key is on renewals is where it really goes to the bottom line, because then that person doesn't go vacant. And now fair housing, you're going to have to offer it to everybody, right? You can't just select, but the fair housing component, you have to understand too. So right there are hurdles with the idea and the concept, but you're right. If it's a 12-month lease, good paying tenant, never missed a payment, always on time, give that guy, maybe if the renewal's going up $100, you give them $75 renewal. Yes, you're losing out on $200, $300 in income, but your turn cost is $650. So right there, you offset it immediately and it goes right to the bottom line. So it's a really cool idea, but obviously you have to vet it wherever you're located to make sure it can be done.
Yeah, for sure. So Steve, I'm curious, we are coming on time, but I always think it's interesting. I want to backtrack a little bit. I think a lot of people always are curious about how people are able to get started, how they're able to get their first deal under contract. And I think a lot, like you said, a lot of younger people try to go for more of those creative strategies. They don't have a lot of cash stockpiled. You're also going to school, which obviously I would assume is costing some money. How are you guys able to get started and, buy your first deals and or save up capital?
So our story was pretty, it's pretty generic, right? We start with go ask a bank of mom and dad, right? Talk to family. And so what we did was, because like my parents aren't as financially literate, they're smart, they're hardworking, they're good savers, but they're not good at investing. So we basically went and did all the education, right? For us, it was joining a coaching program. But nowadays, there's so many great resources out there online, like Bigger Pockets or this podcast that you have, right? Where guys are just giving out amazing content, amazing ideas, like what John just gave me, like for free. And so, get all the education done and then just go out there, tell your family about it, tell them what you're doing, and just start making offers at the end of the day, right? I think what a lot of people do is they overthink it. They think they have to get to step 20 before they start step 1. And it's as simple as find your market first, start making a team, start networking, get deals, give the brokers feedback on the deals that you get, and just start making an offer, right? So for us, we piggybacked on some of the networks we had when we joined a coaching program. But for other people who are looking to get started, just start making calls in your local market. If it's not crazy expensive like mine, if it is, you just start driving or start flying until you go somewhere where it makes sense.
Yeah, I love it. I think it sounds so basic and it sounds so easy because quite honestly, it can be that basic and easy. And I agree. I think sometimes people overcomplicate it. It's where do you want to invest? Why do you want to invest there? And are you buying something cheap enough? If it's not cheap enough, move on to the next one. And that's kind of
totally, Chris. Real estate's like one of the oldest businesses out there. It's a business model that's consistently worked. And, people put their little spin on it, say there's this brand new strategy, but there really isn't. You buy a piece of property where someone wants to pay you for it. And that's the end of the story.
At the end of the day, you guys are both 100% right. Everyone wants the secret algorithm that's going to lead them to the next big pop or booming market. At the end of the day, it doesn't matter, right? There's no secret algorithm for picking up the phone and calling people and finding out that you can't afford something and or the rent to price ratio doesn't work or it doesn't cash flow. At the end of the day, you're talking about a pen and a paper and a phone, right? That's it. That's all you need. There's no algorithm to rent growth and population growth and job growth, right? Yes, you can, if you're super smart and data driven, you might be able to find something, but there's like millions of people doing it. And this goes back to forever. There was no algorithms, when George Washington came to the United States, right? There was when he was the president, there was not an algorithm to figure this out, right? So if you dumb it down to its most generic concept, what you said is perfect, right? Bank of mom and dad, friends, family, find a market you like. It doesn't have to be, it doesn't have to be the next best thing. That's what all people are looking for today, right? It's the next best thing, the shiny object. But educate your network on why this is a good deal, why it's a good investment. Do that and take small steps every day towards that goal, right? Pick up the phone, make a couple calls and figure it out. So you guys nailed it. And that's the end of the day. It's not a super sophisticated model.
Exactly. And the real estate market, it's such an inefficient market too. It's easy to, carve out a small little niche for yourself here and there, right? Like you guys are obviously big players. You do syndications. I've looked at your bio. You guys have 4,500 doors that you own and manage. But even then, it's, there's so many more doors out there, so many more apartment complexes. If you're just talking about buying a single family duplexes, there's millions of them out there. And it's, you don't have to know everything. You just have to get one or two and it'll change your life. Right?
I was a baseball player and you fail 7 out of 10 times in your Hall of Fame. Real estate's not, when I say fail, you can't buy something, lose millions and do it again. But you don't, there are millions of properties. You need one, right? So just be specific to what you want to buy and don't deviate. But you're 100% right. It's a numbers game at the end of the day. Whether you're looking for a duplex, a single family, and or a 500 unit complex. If there's a will, there's a way. You can find it. You just got to start offering on stuff.
Yeah. I know one of the things I get all the time is, like what model do you use? And the question to me is just utterly ridiculous because the model itself doesn't matter. A model is basic math. It's adding, subtracting, dividing, multiplying. Your most complicated thing is going to be IRR, and you don't even really need it for yourself. A model is only as good as the information you plug into it. if you knew, like if a genie came out and told you exactly what the income and expenses were going to be in 5 years and what you could sell it for, you wouldn't need a model. You'd back into how much do I want to make? How much is it going to cost? What do I offer? But unfortunately, that's never going to happen. You're never going to know exactly what it's going to be. So you try to estimate it as best as possible. The model is not going to tell you what those estimates are. And if somebody is telling you what those estimates are from a model and they're telling you anywhere in the country it's going to cost you $200 a unit, throw out that model, stop listening to that advice, because it's never true. Every type of property is different. Every market is different. Every age of the property is different. It all matters. It all gets very specific. The best way to find that information out, and I'm helping a buddy with it right now for a deal in Louisville, I picked up the phone, I called 5 people that are doing it there, and I asked them questions. I called our insurance guy, called the county to ask about the taxes, called 4 other people about what their expenses roughly are to help him out, because you're never going to know except from people that are doing it and have done it in that area on very similar type properties. So it's just funny because a model is just a bunch of numbers on a spreadsheet. It's never going to tell you how the property is going to work.
I love that, because people ask me all the time what your model is, and I go like this. I say, "Here's my model." It's like, I could send you one of these, right? You can pick them up at Staples, but I don't even know if Staples in business anymore because everything closed.
It's high school math, man. High school math. Not even elementary school math.
Yeah, absolutely. But I think that's an awesome place to wrap up. I really enjoyed this episode. So, Steven, thank you so much for coming on. I think people are going to get a tremendous amount of value from it. If anybody just wants to get in touch with you, follow along with you, just talk with you, where can they do all that stuff?
Sure. The best place to get in touch with me is through Instagram. You can find me at Steven Huang, RE. That's my full name, RE. And, shoot me a DM. I'm down to chat about real estate whenever.
Just spell your name for people.
It's StevenHuangRE.
Beautiful.
Guys,
we'll also have it in the show notes if you want to go find it. But if you're listening and you want to go look it up, go do that. Guys, thank you so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. If you are, please send it to someone that would get a tremendous amount of value from this episode with Steven. I think it was awesome. I think a lot of people should listen to it for sure. Once again, bud, thank you so much for coming on. It was awesome.
Hey, thanks, Chris. Thanks, John. It's been a pleasure.